Baghdad, 762 AD. A brand new city. And somehow, the people building it accidentally invented the blueprint for modern finance. Nobody gives them credit for it. Nobody ever does. Here's what's wild. When most people trace the history of banking, they start in Renaissance Italy, maybe Amsterdam in the 1600s, maybe London. But the actual foundation, the contracts, the credit instruments, the risk-sharing frameworks that Wall Street still runs on today, written in Arabic centuries earlier. And the overwhelming majority of modern investors have absolutely no idea. So let's fix that. The year is 750 AD. The Abbasid Caliphate just overthrew the Umayyads, messy business as power transfers usually are, and they needed a capital city worthy of what they were building. By 762, Baghdad existed, right on the Tigris River. And within a few decades, it wasn't just a political center, it was one of the largest, wealthiest, most connected cities on the planet. The location wasn't coincidence. Baghdad sat at the exact intersection of trade routes threading through China, India, Central Asia, Africa, and the Mediterranean. Silk, spices, metals, textiles, everything moving in every direction, passing through one place. And here's the thing about trade. When it grows big enough, coins stop being sufficient. You need something more. You need systems of trust. Think about it this way. Imagine you're a merchant in the 9th century. You've got a trading partner in India. You've got inventory sitting in Andalusia. The journey between them takes months, crosses deserts, crosses oceans, and every mile of it is basically a "please don't rob me" prayer. Carrying actual gold? Sure, good luck with that. The Islamic world had something most regions at the time didn't: relative political continuity across enormous territory, a shared commercial language in Arabic, and a legal framework grounded in Sharia law that was recognized from Cairo to Damascus to Baghdad. That last part, criminally underrated. Because here's the thing most finance textbooks skip right over. Finance isn't built on metal. It's built on enforceable promises. And the Islamic Golden Age had enforceable promises down to an art form. Now, let's talk about the Mudaraba, because this is where it gets genuinely fascinating. The Mudaraba was a partnership structure, simple on the surface, revolutionary underneath. One party brings capital, the other brings skill, expertise, and effort. Profits get split according to whatever ratio they agreed on up front. Losses? The capital provider absorbs them, unless the working partner was negligent. That's the deal. Notice what's not happening here. Nobody's charging fixed interest regardless of whether the venture succeeds or fails. The investor doesn't get paid if the business doesn't perform. Both sides are tied to the actual outcome. Win together, lose together. Incentives perfectly aligned. Sound familiar? It should. Strip away the Arabic terminology, and what you've got is essentially modern venture capital. Investor funds the project, operator runs it, profits divided by contract, losses absorbed primarily by capital. The fundamental architecture of Silicon Valley's favorite funding model was already operational in 9th century Baghdad. Genius? Yes. Surprising that nobody mentions this? Also yes. And here's where it gets even more interesting. Islamic law prohibited riba, charging interest in a usurious sense, which meant financiers couldn't just hand someone gold and sit back collecting guaranteed returns. If you couldn't rely on simple interest payments, you had to get creative. You had to design more sophisticated arrangements: trade finance, profit participation, asset-backed structures. Constraint, as it turns out, is an excellent inventor. But contracts and partnerships only solve part of the problem. You still have to actually move money across thousands of miles. And this is where someone had a genuinely brilliant idea. Enter the Sakk. A merchant in Baghdad could deposit funds with a trusted financial intermediary. Think of them as an early private banker, and receive a written document authorizing withdrawal of equivalent funds at a partner institution in another city entirely. No gold physically crossing the desert, just paper, backed by reputation. backed by enforceable agreement, backed by a legal system that took commercial obligations seriously. The Arabic word Sakk, by the way, eventually became the English word check. You use one every time you write out a payment. You've been speaking 9th century Islamic financial innovation your entire life and didn't know it. Alongside the Sakk, something called Hawala was operating as an informal value transfer network. Brokers bound by trust and professional reputation could settle financial obligations between distant parties without physical currency moving at all. Money shifted through ledger adjustments, through relationships, through reputational stakes that nobody wanted to damage. Critics sometimes call Hawala primitive. It's actually a sophisticated settlement system that understood social capital as a financial asset centuries before any Western economist coined the phrase. Finance scales when trust scales. Simple as that. And trust requires law. The Islamic world had commercial courts enforcing contracts across vast geography. Disputes got adjudicated, agreements got documented, property rights were recognized. Meanwhile, across much of early medieval Europe, feudal fragmentation meant legal enforcement was patchy at best, non-existent at worst. Your contract meant exactly as much as the local lord felt like respecting it that particular Tuesday. Lower transaction costs. That's the boring phrase that explains everything. When you know your contracts will be enforced, you trade more. When you trade more, wealth grows. When wealth grows, you already see where this goes. By the 10th century, Baghdad was one of the most populous cities on earth. Its scholars were translating Greek philosophy, synthesizing Indian mathematics, advancing Persian science. Intellectual flourishing doesn't happen by accident. It rides on economic prosperity. And economic prosperity, in this case, was riding on financial architecture. There was also the Waqf, a charitable endowment structure where wealth could be placed into a legal trust to fund schools, hospitals, and infrastructure, essentially forever. Asset ownership separated from operational control, long-term continuity built in by design. If that sounds like a modern foundation or trust fund, that's because it is. Same principle, different century, different language, same remarkably sensible idea. Here's what I want you to sit with for a second. The Islamic Golden Age didn't just produce financial instruments, it embedded those instruments inside a moral and legal worldview. Contracts were sacred, reputation was capital, enforcement was institutionalized. Financial relationships were constrained by ethical considerations about shared risk and real economic participation. When finance is tethered to actual productive activity, actual trade, actual goods, actual services, bubbles are significantly harder to inflate. Not impossible, but harder. Good thing modern finance completely absorbed that lesson. Opens news. Never mind. By the 11th and 12th centuries, these practices were normalized across the Islamic world. And then, the thing that always happens to good ideas happened. They traveled. Mediterranean trade routes were busy. Italian city-states, Venice, Genoa, Florence, were doing extensive business with Muslim merchants. Ideas crossed alongside goods. The Venetian Commenda contract? One partner provides capital, another conducts the trade voyage, profits split according to prearranged terms. The structural DNA of Mudaraba, wearing Italian clothes. Risk-sharing, limited liability, capital mobilization. The backbone of what would eventually become modern venture finance, already in motion, already proven, already crossing borders. Bills of exchange spread through Mediterranean commerce. Merchants settling debts across borders without physically moving bullion. Sound familiar? The Sakk, scaled up, adapted, rebranded. Finance doesn't get invented twice, it travels and transforms. But here's where the divergence happened. And this divergence matters enormously for understanding where we are right now. As European banking matured, it increasingly embraced interest-bearing debt as its dominant structure. Fixed returns, predictable cash flows, governments borrowing against future tax revenue, banks expanding credit aggressively during good times. The system could grow fast, very fast. Leverage is an accelerant. It's spectacular when things are going up. It's catastrophic when they're not. Debt-based systems that detach from real asset performance don't just slow down during crises, they collapse inward. Credit layered upon credit, derivatives built on derivatives, risk so thoroughly distributed that nobody knows who actually holds it anymore. That description could apply to 2008. It could apply to several points before 2008. History doesn't repeat, but the structure of financial disaster is remarkably consistent. The 2008 global financial crisis wasn't caused by medieval trade disputes, obviously, but it was fueled by precisely the dynamics that Islamic commercial law was structurally designed to prevent. Leverage multiplied beyond asset backing, speculative instruments detached from real economic performance, and risk so obscured that confidence evaporated almost overnight. When confidence went, liquidity went with it, and then governments worldwide injected trillions to keep the whole architecture from folding. Meanwhile, and this is the genuinely interesting comparison, modern Islamic finance, though smaller in scale, had certain built-in constraints active during that same period. Sharia-compliant financial products require asset backing. Purely speculative derivatives are restricted by design. Returns must be linked to actual asset or project performance, not fixed interest obligations. The sector today represents over $2 trillion in global assets, with major hubs in Malaysia, Saudi Arabia, and the UAE. Sukuk, Islamic bonds, provide returns tied to ownership stakes in real assets rather than interest payments. Does this make Islamic finance risk-free? No, nothing is risk-free. The universe doesn't work that way, and neither does money. But it illustrates something fundamental. Every financial architecture encodes a set of values. Debt-heavy systems prioritize rapid expansion and accept the volatility that comes with it. Risk-sharing systems prioritize alignment between capital and labor and accept slower scaling. Both have trade-offs. Neither is inherently righteous, but you should know which one you're swimming in. Then, 1258 arrived. The Mongols sacked Baghdad. Not damaged, sacked. Centuries of accumulated networks, institutions, and enforcement mechanisms fractured. Trade routes shifted. Political authority collapsed. And here's the thing about finance that this moment illustrates perfectly. It cannot operate in an institutional vacuum. Strip away the courts, the enforcement, the shared legal language, the reputational infrastructure, and the most elegant financial system in the world becomes worthless paper and broken promises. The Islamic financial innovations of the Golden Age didn't die in 1258, though. They'd already traveled too far. They were already embedded in Venetian contracts, Mediterranean trade practices, and commercial frameworks spreading across Europe. You can't uninvent an idea once it's been absorbed into global commerce. Which brings us to the actual point of all this, and it's not about pride of authorship. It's about understanding that financial systems are architecture, invisible frameworks, and they don't fall from the sky. They're built by human beings making specific choices about values, incentives, risk, and enforcement. The Islamic Golden Age built one kind of architecture. European debt-based expansion built another. The modern global financial system built on that. Digital currencies, decentralized finance, Sharia-compliant banking expansion. These are the next set of builders, working on the next set of blueprints. History doesn't hand out permanent answers. It hands out case studies. Expensive, occasionally catastrophic, always instructive case studies. So let's be precise about what those case studies actually teach. Enforceable contract law scales commerce, always has, always will. Reducing transaction risk accelerates capital flow. Financial systems reflect the moral and institutional frameworks that produce them. And when trust weakens, finance weakens. Every time, no exceptions. That's not philosophy. That's structural law. The questions Baghdad was answering in the 9th century are the same questions every financial system has to answer. How do you move value safely across distance? How do you align the interests of capital and labor? How do you enforce agreements across diverse populations? How do you prevent power concentration from destabilizing the whole system? Those questions don't have permanent answers. They have contextual ones, and the context keeps changing. Today's global financial system, dollar-denominated, debt-centric, and dominated by Western institutions, feels like bedrock, permanent, inevitable. It is not permanent, it is not inevitable, it is architecture built on specific legal frameworks, specific geopolitical arrangements, and specific policy choices that can and do shift. Digital currencies are being developed by central banks worldwide. Decentralized finance is rewriting assumptions about intermediaries. Sharia-compliant banking is growing. Regulatory frameworks are being renegotiated. The rules of finance have been rewritten before, multiple times. They'll be rewritten again. The only question is whether you see it coming or wake up confused wondering why the world changed while you weren't paying attention. Here at Money Never Learns, we've established a fairly reliable pattern. The people who understand financial architecture before it shifts are the ones who are rarely surprised by what happens next. The ones who think the current system is just how things are, well, the merchants carrying gold across deserts thought that was just how things were too, right up until someone handed them a piece of paper and said, "Trust me, this is better." Some of them trusted, some didn't. History remembers the ones who understood what they were looking at. Good thing we've all learned to recognize the difference between the map and the territory by now. We have, right?